How do you feel about the AI potential AI bubble and how that could affect the market?
Listen, man, this is way above my pay grade in terms of like AI. Like, obviously, I have some smart friends and I listen to smart people. I try to, and they have big expectations. I'm sure there is. For me, in terms of what I can do, what I can control, certainly not building AI algorithms or whatever. Like, I got my friends, they'll do that for me, and then I get to play with the toys they build. Great. And I'll invest in some of them too. That's great. I'm just not going to do it, right? For me, I'm more interested in like, okay, who's winning in all of this? And who's winning is really the biggest players like Google, Microsoft, Nvidia. They're the ones that are winning. Like, from what I could see, the more like pure plays, AI plays, like most all that is bullshit. Like, to me, I think like just the companies with the best resources, the most money, the ones that have been way ahead of this before it got sexy, like, and you look at the charts because that's what's actually happening, and they're winning. Now, are they winning because of AI, or are they winning for a variety of reasons? Probably for a variety of reasons, but the AI probably isn't hurting.
Are you surprised at how much the bond market has fallen? Really since 2020. I know you talked about it earlier. Now I talk about this Rashad and Troy all the time. Like, I never thought I would see like a bond collapse like this. Are you surprised, or does this remind you a lot of the 70s? And do you think we'll be here for the next 3 or 4 years?
Man, let me tell you something. Nothing surprises me in the market anymore. I'm too old. I've seen too much. I'm so numb, and sometimes I like people who maybe not have had those experiences. It might seem kind of like, oh, nothing surprises me. Oh, crude oil trading below zero? Yeah, sure, why not? Yeah, you know what I'm saying?
Yeah, that was crazy. Good negative barrel.
Like, I used to work across the street from Bear Stearns headquarters, like overnight, gone. See ya. No big deal. Just another day, I've seen some shit, man. So, like, am I surprised? No. I've been hearing about this bond sell-off my entire career, right? Like, okay, now there's your bond sell-off. I'm finally 20 years later, right? Like, I've been hearing about this forever, right? Because everybody wants to pick a bottom, everybody wants to pick a top. I could see a situation where we're kind of like in a messy range for a while, and rates, go up a little, down a little, but kind of stay within a range, not have this like secular turn where, rates are going to go to 15% tomorrow. Could we get there eventually? Maybe, but for the foreseeable future, I think it's probably going to be a little muted, probably just messy in general. What I will say is, also the correlations with energy as well have shifted. It's almost like the 60-40 portfolio of stocks and bonds is now really 100 portfolio, because stocks and bonds are moving together, so there's no 60-40 or nothing. But if you kind of like sort of navigate that 60-40 differently in this environment, it's more like a 60 stocks 40 energy. It's more of a 60-40 that makes sense in this environment. How long that lasts, who knows? But my suspicion is it's going to last a lot longer than people think.
So what do you mean 60-40 energy? What are you talking?
Well,
energy
like,
stock or?
Well, traditionally, stocks and bonds don't move together. They've been moving inversely for a long time, right? When stocks sell off, bonds rally, right? And you're still getting your yield if stocks are doing well. So it's kind of like a balance, if you will. But when stocks and bonds are moving together, there's no 60-40, it's 100, right?
No, for sure. I got that part, but I'm saying you said energy. You said energy is the new bonds.
So now you're seeing a negative correlation between the rest of stocks and energy, right? So when stocks are under pressure, you're going to get relative strength out of energy, we've noticed. Right? Yeah. And when stocks are doing well, tech stocks, all these things are doing well, energy is not doing well. So energy is now moving with rates. Right. So as rates are coming off, energy's underperforming. As rates are going up, stocks are under pressure. Energy's doing well in that environment. That's what we've seen. So if you're going to do a 60-40, that would make more sense than a stocks and bonds, when stocks and bonds are just moving together. So it's really just 100.
Got you. Would that put pressure on a company like Tesla being in the EV space if Chevron, Exxon are going up when our market is selling off?
Yeah, like indirectly. Like if the market is selling off, then Tesla's probably going to be under pressure, and a company like Chevron and Exxon can actually do well in that environment. Yeah, I don't think I think it's more of just a coincidence. I don't think one is navigating, like one tail is wagging the other dog. You know what I mean? Like, I think that it's just sort of the way the market mechanics work. But Tesla's like in a messy range. It's been in a messy range for a few years. There's listen, well deserved too. That was a huge move. That was like a legendary move in market capitalization that we've rarely, you can argue, maybe never seen that much market cap grown that fast. We have to go back and do the math, but regardless of whether it's happened or not, it's not something you see very often. So let it take a break. Let it chill out. Well deserved,
Time for a breather.
I don't want to go. And by the way, it's been breathing for 3 years. So, it's
So that's an interesting point, right? Because people will look at Nvidia, they'll look at Microsoft, and they'll say, well, new all-time high, should we get invested? Obviously, we never suggest people invest when it's at its peak. But are there specific indicators that you're using to say, all right, this is now a time that we should be getting into these companies? Because like we said, we know that technology has run up over the past 5 years for sure. Nvidia, we saw had an incredible year last year. Everybody's predicted that it's, the price point is at an average of $600, so there's still room for growth. Are there indicators that you're using or that you would recommend for somebody that's beginning to look at charts that could help them in that journey to say, all right, this is the time to invest?
Yeah, listen, if there's any indicator, it's going to be price, because price is the only truth. Price is never going to be restated. Like, it's a fact. Like, there was a buyer and a seller at this price at this given time, and that's never going to change. Now, the seller might not have wanted to sell, and it was the margin clerk selling it for him, and maybe the buyer didn't get the best price or whatever, but that's the price that it paid, and that's never going to change. And one thing we know for a fact is that asset prices trend. We know that. They go up, they go down, they go sideways. They trend. We know that. And we have the math, right? And if you're into white papers, knock yourself out. They're all over the place. But if we know that, and we know asset prices trend, then as investors, shouldn't we be spending a lot of time looking for trends and finding trends in asset prices? So, we look for trends in the stock market. Are we seeing more stocks making new highs, or are we seeing fewer stocks making new highs? So it's about recognizing trend on a micro level, a specific stock like Nvidia, or analyzing the trend of the overall market, which is a composition of 500 trends or 1,500 trends or 2,000 trends in the Russell 2000, right? And, taking a weight of the evidence to get the direction of the overall tide correctly and try to have the wind at your back. So in other words, if most stocks are going up and the trend for most stocks is up, then you're going to probably have more success in buying a stock that's going up and being part of that group. Now, if the majority of stocks are falling and we're in a bear market, and you're going to try to be buying stocks in that environment, you're swimming against the tide. Like, you have the odds are not in your favor, right? And if you're buying a stock that's going down in an environment where most stocks are going down, then good luck. That's not going to end well, right? So you really want to be in the direction of the trend, and then look for, and this comes over time, is understanding what these changes in trends look like and the process of those changes. And you start to sort of develop your own process over time. But at the very least, someone who's never looked at a chart, like, do yourself a favor and look at a chart and zoom out, right? You look longer term. And that's the beauty of technical analysis, is the ability to use multiple time frames. We want to start with a longer term, understand the longer term trends. We're talking about interest rates, right?
Yeah.
Interest rates were going down for 40 years, and now we're seeing something different, right? Things are starting to change, but these were long trends that persisted for a long time. You look at the Russell 2000, small caps, people are so like, it's short term, it's messy, it's in this range, oh my God, it's not making all-time highs, the market's going to crash. Do yourself a favor, take a deep breath, zoom out, and you'll notice that same Russell 2000 stock has been making higher lows and higher highs for decades. It goes up over, it's been going up over time. I think that this one, it continues higher from here. But you're not going to see that if you're so zoomed in, like a racehorse where you got these blinders on. Like, open it up and zoom out. Whenever in doubt, zoom out. And it'll really help give you perspective. And then you can identify the shorter term trends for your specific time horizon, but doing so within the context of the bigger trends.